As always, I like to get all these meetings started off with, hey, introducing myself, Noble Angliori for those who don't know, but which we are not financial advisors. I know I am not, Malik isn't, Ben isn't, but what we are doing and what we are recommending are solely recommendations. These are solely our knowledge and our plays. And if you are going to use it as investing advice, please do your own research and kind of make sure that it's suited best for you to get started. So tonight, I want to, for the people who are in my community, I told you once we kind of went through the beginning of the course and we kind of got it all completed, I wanted to give you guys some additional content. And part of that content is in opportunities like this, where we get to talk to and have discussions with other investors, right? Where we get to learn from other people in this market who are taking advantage of the wealth, the gains, the opportunities that this market provides, right? So I have none other than a really close friend of mine. I went to school with this guy. That's how I first got to meet him. And he has been one of the biggest blessings in my life, not just financially, but personally as a friend as well. So Mr. Benjamin Cheatham is going to hop on here today with us and be able to drop some knowledge for you all. The thing I love about Ben is he takes a different outlook and a different approach to the markets that I think many of you all might be able to resonate with or be able to connect with. And I think it's very important that you all find investors who do things differently than you, but also do things very similar to you as well. So Ben is one of those guys where I've learned a lot from throughout the years. And now I want to be able to introduce him tonight to you all. So Ben, what's up, bro? How you doing, man?
I'm doing well, Noble. Thank you for that welcome. How are you today?
Man, I'm great, man. I'm great. So for a little bit, I'm going to give people a little bit about your background from a resume standpoint, and then from there we can kind of just go into like a free flowing dialogue. Just tell us a little bit more about how you got introduced to investing and kind of the process that took place with throughout the years. But I met Ben in college, like I said before, as we were both in the Smile Fund together, which was our student managed fund, where we were both a part of a team that was managing $250,000 on the stock market. And then throughout our time together, we kind of grew that to about 700 or 1,000 or so by the time we left. So that's how I got introduced to Ben. But Ben, you are originally from, I don't want to say Nashville, Tennessee, but you're originally from Nashville, and I think so. Tell us a little bit more about how you got your background a little bit, and then kind of how that trickled into you now being an investor and more of like a business person.
Sure thing. I am from the Nashville area, Mount Juliet, Tennessee. Went to high school there, went to college out in UT Chattanooga with Noble. Noble and I were very close for about 9 or 10 months during school before we were both finance majors. I'm also an accounting major, but we started working on this project together. We were real close knit. It was about 5 of us, and we thought it'd be something that we put some weekends in. It ended up being a 9-month project, and it went really well. We learned a lot about investing, finance, working a project management, and Noble got me a trip to Seattle. That'll be for another time, but it was a really great experience. And but yeah, I was as Noble said, we were both members of a student managed fund while we were in college. And at the time, I didn't have a lot of money, paying for school. So I never really invested any of my own money. But after school, I went down to Atlanta and started working for Deloitte as a tax consultant. I got my CPA. I stayed with Deloitte for 2.5 years, and then I left Deloitte. And now I currently work in the investment banking arm of J.P. Morgan and their fixed income department, working on tax-oriented investments. But that's a little bit about my background. As Noble said, I do have a very particular, notion that I like to go about as far as investing. I'm a very passive investor. I'm not very aggressive at all. But what I do, it makes the money that I expect it to do. My expected returns are in line with, what I set them up to be at the beginning of the year. So when I hear people making 60% a year, I'm happy for them. I don't really get 60% a year, but I never really lose any money. So I'm happy about the way that I go. I do lose money occasionally, but in the aggregate, I don't really lose very much
Right.
money in the way I go about my investments.
Well, that's loaded, man. You just gave a great loaded response right there that has so many different areas that I definitely want to hit on. But before we get into your exact investing strategy, I want to take a step back to college, right? When you spoke about you didn't really have the money to invest during college, but you really took advantage of that opportunity, right? Because by learning strategies, learning the numbers and the things in the back end, so now when you actually came into some income, you were like, you know what? I'm ready. I'm ready to make this leap. I'm ready to make this jump, and it's been beneficial and profitable for you. So, what are some of the things, Ben? And for a lot of people who don't know, Ben is actually an accounting major first, and then he added finance as well. So, I believe you doubled in accounting and finance, but accounting is his main bread and butter. As he said, he's a CPA. So, it's not like this. He was doing investments in terms of like stock portfolios or things related exactly to the stock market. He was more related to the accounting side. So what were some of the things that you did or that you looked for when you were teaching yourself the markets and learning about the stock market, how to invest the right way when you necessarily did not have the money to jump in at that time? What were some of the things that you were doing?
I kind of want to backtrack on that. It's not that I didn't have enough. I just didn't feel like I had a sizable amount that I could put aside to start investing. But, you can start investing with, $50, $100 and build yourself a portfolio, especially with partial stocks now. But in school, they gave us a lot of opportunities to, mirror real portfolios. If you get a TD, Ameritrade account, you can get a paper trading account where none of your money's at risk. They give you $250,000 of just, their quote unquote TD Ameritrade dollars, and you can trade with real market prices and real assets and such. And, we had a lot of projects like that, especially, being in the small fund and working on the chartered financial analyst project. There was lots of opportunities to kind of, build up that experience and learning to kind of get, familiar with
paper money is big. I think that helps a lot of people. I know a lot of people have been upset with Robinhood, at least in our group recently. So they've been trying to find other brokerages, and I've been leaning them a lot to TD Ameritrade. And I think TD Ameritrade having the ability to do paper money is big. I think a lot of people underestimate the ability to practice trading and using the same type of strategies you would use when you have the money to do it, and kind of seeing how it plays out. Obviously, if you hit a big home run, you're like, man, I wish that was real money. But also at the same time, when you lose that big chunk of money, right, then it helps you be able to be like, you know what, I learned from this. I was able to take that. So what would you say there were some lessons that you learned from investing in that paper money, or investing or passively investing like in college without having the income that you have now, right? So do you think there were certain lessons that you had and certain techniques and tools that you utilized that back then that now, or that you developed then that you now use today?
Absolutely. I would say the biggest thing would be my research. I think as far as like, you would think that it's highly complicated and you have to, it's best to do as much reading as you can, as much research as you can. But really, when you're going about investing, for just to get started, looking at Yahoo Finance and typing in the ticker, the 3 or 4 letter, 2 or 1 letter acronym for whatever stock you're looking up. They'll have different reports that you can read through. they'll have price estimates for you going 1 year out. They'll have different metrics. They'll tell you like price to earnings. They'll tell you, how the stock has done the last 12 months, and you can read little bits of news. So just really keeping up with the news and, leveraging other analyst reports and kind of seeing what other people say the consensus is really helps. So you're not really looking at like penny stocks, because as beautiful as the idea of penny stocks sound, where you could buy something for a penny and it could explode up to $100, that's enormous returns. Is very unlikely, and you wouldn't want to, in my opinion, I wouldn't want to put a lot of money there. So it's really good to be able to look at other analyst reports at these investment banks and kind of see their opinion on these same assets that I'd like to buy into.
I think you hit on a few key things right there. First one, I really want to hit on that. I think Malik has a question for you too. Is you spoke a little bit about penny stocks, right? So with that, or actually before I take a step back, you talked about doing your research, which is big. That's one thing I've talked to a lot of people about, is doing your research and making sure, and been telling a lot of the people in our course about the importance of doing your research and following the news and keeping up what's going on in the news, right? What are some of the apps that you use? What are some of your favorite sites that you use that give you the ability to keep up with what's going on into the markets and reading these analyst reports that give you the best chance of choosing winning investment plays?
Yeah. Again, I like Yahoo Finance a lot. I read the Wall Street Journal. I believe it or not, you can small 1 or 2 minute videos on YouTube about geopolitical things going on in the world. It goes a long way. It seems like it's silly, you're laying in bed, first 30 minutes, don't get up. I don't know what everybody else does, but that's what I do. And I'll just watch a few videos and kind of see what was going on when I was sleeping, along with reading a little bit of news. So I really just leverage, everybody's news is essentially, saying the same thing, whether it's leaning one way or the other, but a news outlet, Yahoo Finance is a great aggregator of, information. Your brokerage will have information, and, just watching short videos is always extremely helpful.
For sure. I think Dodge had a question for you, real quick, Ben.
Yeah. Hey, Ben, how you doing, man?
I'm doing well. How about yourself?
Pretty good, pretty good. One of the things that you said earlier when you first started speaking was about, you said that you're a passive investor. And I know that there are, different types of investors in here. Noble is more so focused on, long-term investments. And myself, I do a little bit of swing trading, which is more shorter term. But the one of the most important things is risk management. And how do you, as far as you being a passive investor, how do you really go about your managing your risk? Because I noticed one of the things that you said was you occasionally lose money. So how do you go about just managing your risk, in terms of how allocating your dollars or things like that?
Yeah. So one thing that I do is, I stick to what I know. As far as the different types of assets to invest in, I'd avoid futures. I'd avoid put options. These complicated derivatives. You don't need to get into those to make money. You can make. And when I say that, when I say passive investing, it doesn't sound sexy, quote unquote, as far as making money, but the returns are nice if you just really, and you can have nice returns by just staying in line with the S&P, because the S&P is the benchmark. And being invested in the market, you're going to have an underlying baseline level of risk, that market risk premium, just having your assets allocated out there at all, not in your cash. So what I like to do is I like to look at the, there's this document called a prospectus. And it's something that, whoever is managing your money has to give you when you're in a fund that holds multiple assets. And, the SPY is the ETF that most people in the market that's the benchmark that they look to beat. So I take the prospectus from the SPY and I look at their asset allocation, and I buy and hold ETFs that line up with the asset allocation of the market. So they might have last year they had, let's just say 6% in energy, and during the year I held about 6% around that mark, give or take a few points in energy. But I noticed throughout the year that the energy that they were holding was doing terrible. They had like Shell and Exxon and such. So I did some research, and I started looking into what are my energy alternatives, so I can stay within the purview of what's going on with as far as their asset allocation, but get something different than what the SPY is holding. And at that time, I switched out my oil stocks for renewable energy stocks. So I was still in the energy market as far as my 6% allocation. And I got better returns because, there's a lot more growth with renewable energy. So really, you can curb some of that. It's not really curbing the risk, but, you can stay in line with whatever the benchmark by following that asset allocation that they have. And then kind of doing research within, the purview that they give you. 20% for technology. You could find 20% of technology stocks that you like, or you can find ETFs, which kind of, someone does the work for you. They put together a basket of stocks or bonds or whatever type assets. And you can just directly invest in those and just kind of hold those in your portfolio with the same sort of asset allocation.
For sure. Let me break that down a little bit for our group if they didn't understand 100% or followed it 100%. So what Ben just explained was he looks at the S&P 500, the index, right? And he looks at and he uses it based off of the SPY, that ETF. People in my group are familiar with that because I've shown it to them a few times. And then what you do though, Ben, is you look at the 11 sectors that make up the stock market, right? And you look at those 11 sectors and how they are played out within the SPY or the S&P 500 asset allocation. So let's just say energy is 6% of the S&P, and then technology is 20% S&P, and like consumer discretionary is 12%. You try to match those weights with your personal portfolio. But instead of just investing in maybe some of the names that the S&P 500 is doing, you might trade out some of those names in the same sector, but and you might have the same percentage of holdings, but you might just be in a different name that will give you a better return.
Absolutely.
Okay. Well, yeah, that's great, man. I think having a guide like the S&P 500 is really important. And I think that's a great strategy to use for a lot of people because, for a lot of investment fund and portfolio managers, people who have hundreds of billions of dollars of assets under management, they use a benchmark too. They use the S&P 500. They're using the Dow Jones or the Russell 2000. So they're using these indexes, and they're saying, and they're building portfolios by being allocated across these 11 different sectors without being 100% invested in like all of technology. Because if technology goes down, then your portfolio is going to get hit big, right? So you try to make sure that you're kind of balanced out between some of the bigger sectors and some of like the ones that are like IT, which can give you a bigger return. So you kind of maybe have a larger exposure there than maybe some of the ones such as utilities, which might not return you such as big of a return. So what sectors are you confident in right now in the markets? Where do you see the markets heading? And what sectors do you think, are headed towards to have the best year within 2021?
I'd say looking at that question in particular, I really like, the renewable energy space just because there's a lot of subsidies being given by the federal government as far as, tax breaks. They offer credits for renewable solar energy. They offer credits for wind energy. There's some carbon capture going on. So, companies, I would say anything that's, the environmentally sustainable investing is probably the best. I'd say that is what I would focus on. And really any market, and really any industry, whether that be industrials or whether that be energy or whether that be technology, companies that are, moving in that path to do what they need to do to make, the world last. Those companies are really shining in 2021. Even the other day, Coca-Cola said that, by 2023, they're going to have every single bottle that they use be recycled plastic. And, you're seeing in the news every day more and more stories like that. Like, oh, they're going to use recycled, I don't know, aluminum for cans or what have you. So I think that's going to be something that's more normal going forward. And I think, especially with this administration that we have in the White House, I think they're going to get a lot of support as far as tax breaks and deductions, and just sort of ease of operations as far as not being too heavily regulated.
Awesome. Managing your risk, Ben, you're getting into some of the electric vehicle space or electric energy or clean energy space, environmentally friendly space, as you said. You just talked about how you try to have your plays and allocated an allocation with the S&P 500, right? Are you stock picking these names that fit these trends that you think are going to the future or what we're going to see going forward? Or are you picking names or picking industries first and saying, you know what, all right, like I said, 20% inside technology, so I have only a certain amount of threshold I'm giving myself within these parameters? Or are you kind of just investing in names first and then kind of seeing how they fit into each sector or each industry?
I'd say, I'm really big on ETFs, exchange traded funds. And I like to, because they kind of diversify out within an industry, sort of what I'm looking for. And I don't really need to be 100%. I love this particular company, because the other companies will sort of hedge and work with one another within that industry. So I like to look at ETFs, and I like to look at, as you said, an industry first, and then I'll go and look for an ETF. So like, let's say, we were talking and, you were really excited about 3D printing or something like that. And you could see something like that being more viable. And you could see, they're 3D printing, all sorts of things and manufacturing. They're 3D printing, organs and in the medical space. There's lots of uses for 3D printing. So I might look at, if I wanted to get some allocation under my industrials for 3D printing and technology, I might look up, a 3D printing ETF on ETF.com. And, I might find printer, PRTR, yeah, printer. But that's an ETF that follows 3D printing, and I'd invest in something like that.
Okay, so ETFs that really go towards the industry that you're really bullish on.
Absolutely.
Are you bullish on the overall markets going into this year and going forward?
I would say, there's been quite. I feel good about the long term. I'm never going to tell you, that it's going to fall out of the bottom, because as I said, I've only been investing with my money a few years, and last year around March it got really scary. And, you think it's going to fall out of the bottom, you're going to lose everything, it's going to go to zero, it's going to go to negative 1,000, but it never does. You'll lose money, and then you never really lose the money until you sell, so you really don't want to realize any of these losses when, bad times come, because they are going to come, but they're not going to last forever, and you're going to recover. And, over the long term, the market just following the SPY is going to average 6.5%. So, I mean, kind of backtracking, going what you're saying. I think that, maybe there'll be, in a month or two, I'm just saying this arbitrarily, not really based on anything. I think the market might slip a little bit, go down just a little bit, and then I'll get right back on track, and we'll be hot again for the next several months. But I think right now, there is a lot of money pouring into the market, and you're kind of just seeing what's going on in the White House with them talking about things that have been in the news, like GameStop. I think that it could make some people want to pull out of the market because they might feel like it's a casino, it's rigged or something like that. But it's absolutely not. That's not where I want to go with that, and that's not what I believe either. And that's not the way that markets operate. But I do think there's a lot of people in the market right now who probably aren't in it for the long term. So I think they'll pull out their money in the next sometime this year. We'll get a little bit of pull down and then go right back to business as usual.
Why don't you think these people are here to stay? Why don't you think that do you think these people who would pull out are institutional or more or I'm guessing retailer investors, right? Like ourselves. Why would they leave this market if it's been very lucrative, like it's been the past several years? And why do you think that would be a thing, taking money off the table rather than more people like ourselves, like the people that are in this course and this community, continue to grow and the markets grow?
Because investing takes discipline. I mean, my little brother, he's also a finance. He's a finance major in school right now, and the other day he bought some Dogecoin that was really popular. It was doing great for a few weeks, and then it went down. He bought it at the top and it started going down, and he sold it. He held it for a day and then sold it, and then it was the end of the world. And then 2 days later, it goes back to where it was when he bought it. So he ended up losing money. And I think in saying that, I don't think people have the discipline to just. I don't think the majority of people in our investing market right now, because a lot of people have been sitting at home, they've been getting money, and some people have been getting more money than with unemployment and other things, getting more money than they typically be getting from working, and now they have a lot more time on their hands. And they might not have their boss over their shoulder, so they might be on their phone. And Robinhood and these other brokerages have become almost like a social media. So I feel like a lot of people are just in it right now because it's big, it's hot, it's cool. But when you have $1,000 sitting aside, and you could want that new Gucci purse, or you could want to take that vacation, or you could want to buy that new iPhone, you could definitely do it. You have $1,000 sitting aside, and nobody's really holding a gun to your head, making you keep it in there. So I think,
right.
In the coming months, when things start to move towards the normal and people have to start going back to work and we all get vaccinated and such, I think that, people will just be like, I'm not really into this anymore. It was cool when GameStop and AMC were going heavy, but now I want to get back to reality. And reality for them is just, we're a consumer-based economy. We spend our money, we spend, I think, upwards of 95% of the money that we earn. People don't really save, and investing is saving. So I don't really see, saving being a hot, cool trend that sticks around. So
the markets right now, we believe, are a product of the amount of time that we've had, the freedom of time that people have been granted. And if things pick up to a normal standpoint, in terms of, maybe back in the office, so less time at the house, the ability to multitask, like have your work computer right here and have a chart up on another screen or something, that kind of freedom might go away. And as a result, people might not be able to be as disciplined in the markets or be able to be as successful in the markets, and it could cause some people to no longer be interested in the market.
Absolutely. Like even just sort of looking at a very small example with like GameStop. I know I'm kind of harping on this, but it's very recent. if you would have bought GameStop while it was going up and then you held it and then it started going down and that was the first thing you invested in and you sold it on its way down, or you didn't hold it, or you really didn't do your research, or you really couldn't tell anybody why you were buying it aside from, well, Ralph over there bought it too, so it's going to keep on going up until it gets to the moon, then, you might not have a very good experience with, with investing, and you're probably not going to continue to do it. And that's an example of people losing money, but there's been examples where people just invested in the NASDAQ, the QQQ last year. The NASDAQ made almost 40%. But again, just having people would rather have that money in their checking account and be ready to spend than, essentially be harboring it for a day down the road. So I think that people typically and generally will move out of that saving mindset as soon as they have the opportunities to spend, go on vacations, go to concerts, do the things that they like to do, because right now people can't really do those things.
For sure.
Ben, don't you think that maybe, just to kind of argue the other side, you don't think that maybe that, the stock market, I guess this kind of time that we're in, is revealing to people that this is another way that, a viable option to make money, a viable option to, make quick money, you don't have $100 by the end of the week and you want to see if you can make it real quick. Don't you think that there's also that element to the stock market that people are realizing, that maybe people are going to stay in the market because they know that there's money there to be made?
Sure, I do believe,
Basically, what I'm saying is I don't necessarily think that they're going to just be, an influx of people just leaving the stock market all of a sudden and not wanting to put it in the market. That's, I think that there's still going to be, a good number of people that are still going to want to put their money in the market now because a lot of people are learning about what it is.
Yeah, absolutely. I agree with you. I don't think, 100% of the new people who joined last year will want to pull out this year. But, I do think a good majority of them will kind of, when it's not, really the thing to do anymore, they'll kind of just recede away from the whole investing mentality. And I do understand there's a lot of people who can sort of look at it as another source of it's a wealth producing portfolio. Some people will look at that. Some people get really serious about their personal finances and stuff. Some people will look and say, hey, I have $100 on Monday. I can make it $125 by Friday, or I can make it $200 or $500, Of course, there'll be people, who want to stay in and do whatever they're going to do in the stock market, whatever, their prerogative is. But I do think for the majority of people who did get involved, it's just going to be something else they signed up for. There's no subscription, luckily, to be invested in. I don't really think that. I think probably, 6 out of 10 people will probably, who joined during the pandemic, will stop investing. They'll probably be done within like a year.
That's interesting. That's an interesting point, Ben. I think it's something that we have to kind of gauge and monitor, because there are people who want to make that quick money, who don't have the patience, and they want to hit that home run and see their money go from 1,000 to 10,000 in a month, right? But then there are also people like yourself who have committed to these markets from an investment standpoint and said, you know what, I'm going to use this not only from an income standpoint, but from a wealth generating standpoint. But to your point, that discipline is so important to have. And I think that's just something that I've talked to a lot of people in my course about, is the discipline, the mindset that you have to have every day that you come into these markets and say, you know what, I'm committing capital to this, I'm committing money to this. And I think you're one of those people who personally, I believe your discipline is on such an extreme level that it's allowed you to have success in your life, with your CPA at a young age, and some of the advancements that you've made from a corporate standpoint. But I want you to talk a little bit about the discipline, the mindset that you have in the markets every single day, how that blends into your strategy, right? So I want you to introduce the people a little bit to your strategy. For many of the people who don't know, and Ben will get into his strategy a little bit more, the thing about Ben's strategy is he's not looking for that GameStop. He's not looking for that Dogecoin, right? Ben is cool with, I talk to Ben all the time, and he will have 10% winners over and over and over again. And he will just pocket 50, pocket 100, pocket 100, pocket 50. But then at the end of the month, at the end of the year, he has an overall return that's beautiful because he's taken a lot of the small gains, the small victories, and it's allowed them to compound instead of looking for just like a huge play that's made it very lucrative. And that requires a ton of discipline to look at an investment and be up and say, you know what, I'm gonna cut it and find the next one, rather than being like, hey, this thing is gonna run a little bit more. This thing's gonna run a little bit more, because I've fallen guilty to saying, nah, I think this thing could go some more. And the next thing you know, you're down on that contract, or that stock gaps down, and you're like, you know what, it's gonna go up, and then you get caught. So how do you build out your strategy and keep your discipline and that mindset in the markets? How do you blend those two together?
Sure. So, with every investment that I get into, I sort of develop a time frame for how long I'm going to be holding something. So, there is a time, sometimes, there's times where I have a lot of time to sort of be looking at my phone, and I can be like, okay, I'm going to hold something, maybe a couple weeks. I'm going to hold something a couple months. I'm going to hold something indefinitely, and I sort of, in pairing my investment horizon, I pair my expected return. So if I'm holding something, I sort of look at it. I've done my research. The stock is trading at $40. I think that the stock is going to get to $60 by X date. Then I'll hold it through that date. And if it doesn't really do what I want it to do by that time, then I can be out of it. Or, if I think that, there's developments outside of, what I originally had thought when buying that particular asset, then I'll continue to hold. But, generally, I've sort of more moved into just kind of buying and holding. That was more or less, my predecessor strategy, as far as my preceding strategy, as far as, keeping things shorter periods of time. But now it's more or less just buy and hold. So mostly it's just, I like an industry. I'll do the research on an industry. I'll buy an ETF for the industry. I only hold about 5 stocks. And I really never really plan on holding really more than 10 stocks at a given time. And everything else is just ETFs. And that's just me personally, just because I don't want to put, a lot of money towards any one stock in my portfolio that, I manage.
Understood completely. So we had a quick question in the chat. So do you constantly, so you buy and sell these names are you looking for a certain percent return, or do you have set rules that you typically tend to follow, where you say, I know you said you're now shifting more into indefinite buy and hold type of strategy, which works as well. That's kind of my thing as well. The buy and holds, just quality value names and mixtures between value and growth stocks, and just letting that thing run, right? But when you were more actively trading names, actively in the markets, did you have set rules that you were following, or what exactly were you doing with your stocks that you were buying and selling for a certain amount of periods of time?
So the way I previously looked at it is, I bought something at $40, $50, and, I might I might stick around. I'd say, hey, you know, the price target on this particular asset says it's going to go to $60. I'd hold it till it gets about $60, you know, because that's generally in my head. I was kind of thinking everyone else was doing that research and they were going to get out at $60 as well. So I'd stop at like $58 or something of sorts. But now for me, it's just sort of buying things that I really like and holding them as long as I possibly can. So I don't really do too much constantly buying and selling, especially with my current job. I have the restriction. I have to report everything before I make the trade, and it has to be approved. So I don't really have the ability to, you know, constantly be in and out of different stocks and assets and such. But now it's buy and hold for me. It's buy and hold for me.
And with those buy and holds, are you looking at more bigger value names, or are you looking, what type of companies are you looking at? Not just from not an industry standpoint, but from a price standpoint. Are we looking at $10-$20 stocks here, or are you looking at more of the plug powers or the solos, like the companies that have the ability to become $100, $200, or are you already invested in more solidified names such as like the AMDs, the Apples, the Walmarts of the world, or blend?
So when I do look to buy a stock, I'm a cheap guy. I'm a frugal guy. I'm not a cheap guy. Let me backphrase that. But I like to stay under about $45. Typically, my research, if I'm gonna look to buy a stock, it's gonna be below $45 and above $25. I don't really know why I've picked that, you know, particular, you know, price range, but that price range is really appealing to me, just because I kind of feel like it's there's a lot of, even though, you know, when you look at a company, companies are valued based on essentially where analysts believe their market cap will go. So the share price is irrelevant. But for me, you know, optically looking, I like something that's $25 below $45, because I know, or I would think in my head, you know, intuitively, that something like this has a lot more velocity in the market. It's a lot easier to trade something that costs $30 than it is to trade something that costs $3,000 like Amazon. Every last one of us would buy Amazon if we could, but it's $3,000. So
right.
I'm not trading Amazon, even though I hold ETFs that hold Amazon. I don't really have any Amazon because it's expensive. It's very expensive. Even though I might buy as much, you know, you might buy $1,000 worth of something. I don't want to buy $1,000 share of something. It's just, for me, I don't really, it's not appealing to me. But yeah, I like to, going away from the optics, between $25 and $45, I like to do my research from there. I'll go on different brokerages. I do kind of like the presentation of Robinhood. If you go on the website, you know, you can go into search, you can toggle between $25 and $45, and you can look by popularity, press on the stock, and then start doing your research from there. You know, you can start doing the ones that are least popular. You can start doing the ones that are most popular. You can start doing the ones that have a high buy rating or a low buy rating, and you kind of can make your own thesis from there. But I really like to look within that band, and I like to find, you know, what can be up and coming in that range, because typically, you know, things that are from my, you know, experience, something becoming $25, something that's $25 becoming $40 in a few months isn't extremely crazy, you know, especially in the market.
And that's 100% return.
Yeah.
And that's doubling your money. That makes sense. So I'm going to open up the floor for some questions here real soon. So I've had a few people say they had a few questions. So I'll open that up real quick. But last question I kind of want to ask you before we open it up for questions, Ben, is when you're doing your research, you don't have to get too granular. Give me some high, quick level hitters that you look for, that you like in these companies, right? You just gave me $25 to $45 in price. Do you look at companies that have had sustainable earnings over a 2-3 year period? Are you looking at just popular names? What are some of the things that in your research that you're like, all right, it needs to check these boxes off for me for it to be a winning investment in my book?
So first things first, I like the price. I gotta like how much I'm gonna be paying for it.
Yeah.
Secondly, I like to look at, are the revenues growing? Are the earnings growing? And if the earnings aren't growing, and if the revenue aren't growing, do they have a legitimate reason for why one or the other isn't growing? So if the revenue's not growing, why isn't it growing? If their earnings aren't growing, are they doing more, are they buying more assets? Do they have like more depreciation? Are their expenses going up? As far as revenue, are they not getting new customers? Are their customers not spending as much as they could be spending? Is it's done growing? So I like to look at those two things: the top line and the bottom line. Is the revenue growing? Is the income growing? So those two things. I like to look at the industry. Renewable energy, e-commerce, technology, things of sorts, and another thing is when those other boxes have been checked as far as those other three things, is it something that is there a lot of people covering it? Has it been in the news? Is there 10 analysts covering it, 12 analysts covering it? Do you hear about this company in the news pretty frequently? Because even when Uber was I held Uber for a fairly long time, and Uber was around $40, and it just sort of stayed at $40 for a year, but it was always in the news. And, something that gives you the promise of, makes it easier to keep up with if you can see news correlating with it as well, as the company matures. So those are all things that I look at when I'm looking for new investments.
I like it. I always tell them news drives the markets, man. News drives the price. If a stock is not in the news, then it's not going to have the volume. There's not good things coming out about it. It's not going to be a positive name, I like that. All right, so I'll open the chat up to some questions. If you have the ability to use the raise hand function, please do so. But if not, then just unmute yourself for a few seconds prior. Okay, I got a question from Anthony real quick. Let's get it, Anthony. You feel free to unmute yourself.
Cool. Hey, Ben. I appreciate all the advice first and foremost. I'm a pretty green investor, and I'm someone for a while who I've been saving more money, and I guess as you guys say, I've been losing out on some of that money, and I'm looking to invest. But you mentioned it earlier, I'm in a similar situation to you where I don't have a ton of money to invest. So how do you find that balance between money to be saved and then money to be invested in? Or is there any kind of balance at all in there?
Absolutely. And thank you for that question, Anthony. Investing and saving are one and the same thing. If you think about it, when you're just putting money in a savings account, you're essentially investing in a US Treasury, and you're getting whatever it yields, which could be like, 0.1% or 0.25%. And when you're putting money in the stock market, or, you're buying, property, or you're buying whatever sort of asset you're buying that you're hoping to help you create some wealth, you're investing in that's your underlying there. So for me, when I was starting to be able to build up my portfolio, I sort of looked at, a lot of ETFs, because what ETFs do, the exchange traded funds, they allow you to get a lot of exposure for one price. And my favorite ETF was and is the Motley Fool Composite. Is TMFC. It is a collection of the 100 largest stocks traded on the US market. And, it touches every industry, being the top 100 stocks. It's just the top 100 out of the S&P 500 and at the time, I was able to buy it for as low as $22, and I think now it trades at about $37. So it gives you just buying, and especially with partial shares, you also have that as well. So I bought the Motley Fool composite because at the time they didn't have partial shares, and the SPY was like $300, and I didn't have the money to get into something like that. So you should think of them as the same thing, and you should think about, do I want to diversify do I want some of my money to just be in cash, in treasuries, or do I want some of my money to be in stocks and ETFs and bonds, or do I want some of my money to be in portfolio? It's all saving. Saving and investing are synonymous. They're the same thing, but it's just, how you want to go about, the risk, and how you want to go about ease of turning it to cash. So, but sorry to get for the long-winded answer to that question, but looking for cheap ETFs that give you a lot of exposure to what you're looking for is the best way to get in.
Appreciate that. That all makes sense.
Awesome, man. And that was a gem right there he just dropped on us, guys. I just pulled that ticker up real quickly. And if you saw, it had Apple, Microsoft, Amazon, Berkshire Hathaway, all within that one ETF, $37 right now it's trading at. So it gives you exposure to some of these bigger name companies without having to drop the hundreds or thousands of dollars that some of these shares will cost you. So that's a big gem right there, Ben. Jeff, give us your question, bro.
Hey there. Thanks for the information, and thanks for the opportunity to be a part of this. I'm also a pretty green investor as well. And at the end of each week, I'm looking at my earnings that I've made through the week, and then I'm trying to basically gauge what I want to put into investing. So whenever you're investing into these ETFs, what kind of percentages are you breaking down into what you want to put into ETFs, and then what you want to actually worry about on like a weekly basis? And how do you commit to not looking at something day by day, and let just like a small drop one day maybe turn your tide to sell too early or something along those lines?
Yeah, thank you for that question. I think, that's really important to kind of, get over once you start investing, and you got to realize you're in it for the long term. You're not in it for tomorrow. You're not in it for next week. You might not be in it for next year, and the money that you're putting aside, it's an investment for your future. It may not be an investment for your retirement. It might be an investment for your home. It might be something so you can, have more money to put down on a car later. It might be something for whatever you want it to do. It might be your vacation fund. It might be your college fund, whatever it may be. But essentially, just to not, you can look at it every day. There's nothing wrong with looking at it every day, but you just gotta develop that resistance to be like, okay, I want to pull out today. I've made a lot of money. Oh, I want to pull out, because I've lost a lot of money. It's all long term.
That's psychology, man.
Yeah. So, I hope that answers the whole question. If not, please let me know.
Yeah, that was pretty much because I'm all along the ADHD line of just constantly doing things. But so with that kind of information, I understand what you mean there. But at the end of the week, whenever you are deciding what you're going to invest in, I've actually heard about some ETFs. I can't remember what QQQ actually stood for, but I got a good buddy who invested in that several years back, and he's already tripled his earnings. So how much are you, whenever you're dropping into these stocks and things, how much are you setting aside for ETFs, and how much are you setting aside for more of like a weekly trading thing or a day-by-day trading thing?
Oh, so the way I sort of break down my ongoing investing is sort of, I put, you know, the the government has, things in the tax code to allow you to essentially be able to take a deduction for the money that you put into the market. So, what I'll do is I'll put money into my traditional 401k first, and then I'll put money into my Roth IRA next, and then I'll have some money after that I also have determined that I need to save. And as far as that, I just continue to buy what I already have at the same allocation. So I'm not really, unless I get a hold of hearing something from Noble or somebody else about like, hey, you should look at this, or I hear from somebody else, or I see something else in the news. I'm not, for me at this point, I'm not really looking to be like, oh, I want to day trade with this, or I want to, set this aside so I can trade, something else. I kind of just keep on buying everything that I have at the same proportion. And also just because of my job now, I can't really be actively investing as far as, day to day, because I have to get everything cleared, and, it might take a day or two. So I just continue to buy what I already have. But, I trust that the research that I did preliminary in before I bought it is gonna, can allow me to have continued success, because I bought those as a buy and hold to, keep on, to essentially preserve, wealth.
No restrictions, no job that's withholding you back. You're making a steady flow of income. How much of your income would you say net? So after you paid your bills and stuff, would you say that you would put into the market, percentage wise?
Oh, me personally, I think, as I said before, that Americans, if you look at a lot of the economic data provided by our the White House, our central banks, our Federal Reserve banks, Americans save less than 5%, and I'd like to have the financial freedom going forward to, be able to invest in, companies, like whole companies, and be able to do the operations, sort of private equity on my own hands, maybe buy like a Applebee's or something like that down the road. I don't know what it might be, but something like that. So I save a lot of money. I save about half of my income, which is a lot. I really couldn't. If you can save a quarter of your income, you definitely should. I certainly believe that everybody, if they can, should be saving, a quarter of their income. But I still live like a college student, honestly, and I save about half of my money. So
a quarter of that income that you saved, is that savings account, or you're putting that in one of your ETFs to kind of just allow it to grow? And if an opportunity comes, like you said, to maybe get a franchise or real estate or some of these other investment vehicles that you're looking at, or just let's just say your car breaks down, right, and you need to get a little bit more cash. Are you selling your ETF and using the money from there? Like, how much of that quarter is actually going into the markets for you?
So for me, I have money that I've set aside to say, expect the unexpected. And I have, about as much money as, I don't have a house right now. I don't own property, so I don't have, a $3,000 repair that could happen. The most expensive repair that could happen for me would be, if something happened to my car. So I think that you should have enough money set aside, and you should do that on an ongoing basis or as quickly as you can, to be able to pay the biggest expense that you could predictably have, whether that be your HVAC going out, or whether that be, your car breaking down and having to replace a transmission. I think that those things, you need to have that money set aside first before you start, going into the markets. So as far as the money that I set aside just to put in cash, I don't really put any more money in cash. Everything else I have is going into the market because I've already set that money aside for if the car blows up and I need to buy a car. I don't have money for a full car, but I have money to kind of keep me going.
Emergency fund and then markets after that. Understood completely. We've got a little bit over 8 o'clock. I want to thank you, Ben, so much for coming and taking the time to give us a few gems. I will ask anyone else if they have any questions. If we have any more questions for Ben, but I'll let you think of those real quick. Ben, before we hop off here, man, I want to ask you to give us, you gave us one ETF, TMFC. What about, give me any other stocks? Ben was actually the guy who put me onto Jumia. Most of you guys might not know what Jumia is, but they're like the South African Amazon. Their stock has gone absolutely crazy. Ben recommended to me about $20. And I think now they're 60, somewhere in that range, Ben? So do you have any stocks that you like, specific names, specific ETFs? You gave us a few industries earlier to think about, but do you have any specific stocks, any specific plays that you would personally be looking at and investing in? No thresholds, no job. You don't have to worry. You know what I'm saying? No restrictive holdings based off of your job. You are free to. What would you buy?
I don't mean to beat the horse dead, but I'm going to beat the horse dead. The FANG. So there's a FANG ETF that holds like Amazon, Apple, Microsoft, Alibaba, JD.com. It's called FNGS, and it's $31, and it allows you to have exposure to, that. And I think it's 4 other stocks. And, those companies are really, they're really well performing. They recently had a stock split. They were originally like $110, and now it's $31 as of Friday. So I think that's really great to get into. I mean, Google.
What was that ticker, Ben?
FNGS.
Okay.
I think, I can't really foresee anything that's going to pull down Apple severely, or Amazon, or Google, or Microsoft. And I know that, they might have lower returns than, some crazy penny stock that, nobody's really following. But these guys are going to give you, for the most part, year to year, probably 10%. So I think that's a really good. If you're not going to go with the Motley Fool Composite TMFC, then I think that's also a really good one to buy in that price range. So I really like that as well.
Perfect. I love that, man. Ben is also, he's the main guy. We didn't get to hit on it today, but I'll probably have you back again sooner rather than later and tell us a little bit more about your international strategy. Ben loves a lot of international companies as well, because he thinks, and there's obviously a lot of opportunities here in America, but overseas, you identify there's a lot of plays in emerging markets and other areas that could be very beneficial and lucrative in the long term, right?
Absolutely.
For sure, man. I appreciate it, guys. I appreciate you all for jumping in today. Ben gave us a lot. If you guys didn't, if you have any other questions or anything for follow-up for Ben, feel free to reach out to me, reach out to Malik, and we will definitely get that question over to him. If you've had anything else that you all would like to share, please let us know. But thank you so much, Ben, for taking the time to hop in and talk about a few different things today. You hit on personal finance, you hit a little bit on asset allocation, risk management, and how to really be sustainable in this market in terms of a long-term standpoint, right? In terms of making your money and really being able to take advantage of what this market has to provide for us, man. I greatly appreciate it. And like we like to end off most of our meetings, Ben and I are business partners, so we meet often. We always do a call of the week or a stock to look up. So he gave us that FNGS and that TMFC. I put both of those tickers inside the chat. So take a look at those ETFs, and hopefully we'll have a great week in the market. If you guys have any other questions, please let us know. Thank you guys. Have a great night. Appreciate you, Ben.
Thank you for having me.
No problem, bro.